Welcome. You're listening to John Highman from Commercial Real Estate Online. This is one of the many training videos we put out for commercial real estate brokers and agents around the world. If this is the first time you're seeing one of our videos, then by all means visit the website at commercial-real-estate-training.com. At that website you can get plenty of tips, tools and ideas to help you with your brokerage and agency activities, be it in sales, leasing or property management. So let's get on with this particular video, and I'm covering the topic of property management today in a particular way. This matrix I use from time to time in many different ways to help property managers, retail, office and industrial property managers to understand their market, their activities, the things that they need to do every day. In saying that, today I really want to focus on one topic out of all of these, and I'm going to pick on income. Now, income, of course, is critical to the performance of the property and the targets of the landlord. In most cases, in a property management appointment, you'll be working for the landlord. So you'll be looking to optimize the income for the landlord over time. And of course, the income will come from the tenancy mix, the tenancy base, and the leases that are part of that. So, in saying that, let's pick one of these subtopics and we'll move ahead with that. So, firstly, I'm going to pick the topic of outgoings. So every tenant will have a relationship to outgoings as part of their occupancy. Let's say you have lots of tenants in a building that occupy parts of the building, suites or premises within the building. Each lease will have a relationship to outgoings. That being said, you really do need to review the lease so you understand it totally. Of course, the lease itself will have a description of the rental, and that will be either net or gross. Now, a gross rental means that the rental has been grossed up for the tenant to pay to the landlord. So the gross rental should actually include a component of outgoings. However, that being said, it's a total amount and it's not normally reconciled unless the lease has something strange or unusual to tell you to do that. So a gross rental can be quite good for the landlord from an occupancy point of view. What happens is you take a net rental from the market and an outgoings component from the property. Let's say the net rental from the market is $400 a square metre, and obviously for my friends in the United States you would convert that to a square foot, but let's say it's $400 a square metre and maybe the outgoings are $100 a square metre. So you add the two together and you come up with a gross rental of $500 a square metre. So that being said, if it's a gross rental, then normally speaking there's no reconciliation requirements in the lease at the end of a financial year. If however it's a net rental, there will be reconciliation requirements, and the lease will describe the outgoings that are to be recovered and paid as part of the net rental process. So the net rental, of course, is a net rent plus a component of outgoings. The lease will explain what those outgoings are, and of course the property manager has to get on top of the recovery of those outgoings for that particular tenancy within that property. So let's have a look at it further. Understand the averages of outgoings that apply to the property type in your town or city and location. So if let's say you're managing an office property in a particular town, you should know the outgoings averages per square metre or per square foot for that property type. That being said, it allows you to make sure that your property is performing within the averages for that location. If of course it's not, it can become almost unlettable from a tenancy point of view, because many tenants will have difficulties in accepting a high outgoings component if it's above the averages for the area for that property type. So always understand the averages for comparable properties in the local area. That is the averages of outgoings. So let's have a look at it further. When you take on a property, a new property management, get the history of the outgoings that apply to that property, and perhaps you can get that history from the previous property manager or from the landlord today. The history over the last 5 years will be very helpful. It will allow you to understand just what the outgoings are doing by category throughout the year and how they have changed over time. And of course, history will also help you with reconciliations at the end of the year. I'll just go to this point here. In some circumstances and with some leases, you will find that base years apply to the calculation of outgoings. And that is particularly because the gross rental in some situations will have a base year component. In other words, the gross rental will be established on a base year of perhaps 2012, 2013, and any outgoings escalations above the base year of 2012, 2013 any outgoings escalations will be paid for as an extra amount. So let's say the outgoings base year in 2012-2013 was $100 a square metre. Let's say in 2013-2014 it goes up to $125 a square metre. That will be an escalation of $25 a square metre, and that will be recoverable if the lease is on the basis of a gross rental with a base year component. So you need to read the lease, interpret the lease accordingly. And again, for all my friends in the United States and overseas, I will say that it's necessary to make adjustments to your rates per square foot when it comes to rentals and outgoings, but that's normal and you would understand that. So outgoings are pretty important when it comes to understanding the income for the property and each tenancy within the tenancy mix. So let's go back here and look at some other categories. Rent. Now rent, of course, is the payment of rental. It's in addition to the outgoings, or rent might be that gross rental I talked to you about earlier. So let's look at some issues. What's the passing rent? Well, the passing rent is the rent that's paid by the tenant at this point in time for their property in that location. It's the actual amount paid. So the question to the landlord would be, Mr. Landlord, what is the passing rent for this tenant? It's a worthwhile question. When I look at a tenancy too, I'd be concerned to see that the options are under control. In other words, any leases within the property, make sure that the leases are being watched for the option that could be coming up. If that tenant has an option to renew for a further term of years or months, understand when that option is to be exercised and keep your diary well activated for that system to get that process of option underway. Get involved with the options well before they're due. Don't let the option window close because you might want that tenant to stay in the property. And indeed, they might forget about the option, so that's a bad thing. So, rent, understand the options. The passing rent's what's being paid. When you have a look at rent structures, of course, there'll be rent reviews within the property, and rent reviews will be perhaps based on some consumer index, perhaps based on a fixed percentage or a fixed dollar amount. Either way, those rent reviews will apply at a particular point in time, perhaps once every 12 months, perhaps once every 2 years. But each tenancy, each lease will have a reflection to rent reviews. Understand when the rent reviews are to be calculated, how they are to occur, and of course implement that process. Be very careful when it comes to market rent reviews because market rent reviews are based on the trends of the market, and you will need some preparation time to get your head and your facts around the market rent review for that property, for that tenancy in today's market. So if I'm still looking at rent within a property, I'd be concerned about the rent statements. I'd want to check that they are accurate based on the current passing rent and also based on the outgoings that are actually being paid, the outgoings that I went through here before. So look at the passing rent, look at the outgoings, and then consider that the rent statements are correct and accurate. So let's go over here and just cover a couple of other issues. Net rent I've already spoken about. That will be the net rent to the landlord plus a component of outgoings based on the lease terms and conditions. Make sure that you've got the facts together there and you understand what the lease is saying, and indeed you are charging the net rent correctly for that situation. A gross rent, as I said before, is usually a net rent plus a component for outgoings. In other words, you add the two together. You add that, the outgoings, and that, the net rent, to get to a gross rental amount. And once you achieve a gross rental, that's the rent that's charged under the terms of the lease for the particular year or the rent review process, whatever it is, but read the lease and it'll tell you how it's done. Once you do a gross rental, that's quite good because usually the rent is fixed and it's just escalated at a rent review percentage or dollar amount over a period of time, and that's great because then you don't have to worry about reconciling outgoings anymore. That being said, in the last section of this video I did talk about, and let's go there, I did talk about base years, outgoings base years. Well, if you have a gross rent with a base year, then you will need to worry about those reconciliations for that gross rental because there'll be some overage, some extra amounts of money to recover above the base year for those tenancies who do have a gross rent with a base year. So let's look at these other ones here. What's a face rent? Well, a face rent is the rent that is inflated for the tenancy to allow for the incentives to occur. So, for example, if you create a new lease, you get a new tenant into a property, let's say you have to give them 3 months rent-free or 6 months rent-free as part of enticing them to go into the lease. Well, if that's the case, the rental is regarded as a face rent because what you've actually done is given away something to get the tenant to go into the lease. So let's say the 6 months rent free is actually equivalent to 10% of the rental. Then 10% of the rental over the lease term should be deducted from the value of the rental to create an effective rent. So if you have got incentives in a property, face rents will be active. If you don't have any incentives in a property, then effective rents will be active. But as soon as you get an incentive, face rents kick in. And it's a valuation term. It's to do with how you value a property. It's there specifically to make sure that the rents are not artificially inflated by the manipulation of an incentive to get a tenant in occupancy. That's not to say that you can't do an incentive. Of course you can. But when you do an incentive, it will be taken off the bottom line of a property valuation. And what the valuer will be trying to do is to get to an effective rent. So they'll take the incentive off the face rent and get down to that number. Then they will value the property based on the effective rent. Interesting, isn't it? So let's have a look at this one, rent, income streams. Quite a special little topic. And that says that in addition to all of these things here, you can chase some third income streams relating to the tenancy within the property. So third income streams would be something like car parking, after hours air conditioning rental, perhaps signage rental, running cables to antennas, for example. And all of these things are in third income streams. Perhaps you can do a license for external areas outside of the premises that the tenant uses. Those third income streams are usually covered under some form of license in addition to the lease that already exists. So there'll be another document for this. So what you're doing here is having another document to support the income stream. You're boosting it. So all of these things apply in the normal rental, but this thing here applies in a special rental for something else. So that's what rent is all about. So let's go back here and look at some other things. If I was taking over a property today, I'd want to check the rent statements. I'd want to make sure that they are accurate based on the leases. So I would have to check the leases. Of course, I'd want to make sure that the rental is correct based on options, rent reviews, third income streams, licenses, any extra car parking, etc. You check it all. And then, of course, you look for the arrears that could be occurring. And if there are arrears, then you need to work out what's going on, whether there's a payments plan in process or whether some other things are being done with the landlord regards those arrears. Of course, get copies of documentation accordingly so you can track the arrears and recover them as appropriate over time. So let's go back to the main topic again and look at perhaps sundry recoverable outgoings. What are they? Well, they're the extra things that kick into the property as part of tenant occupancy. And to a degree, I mentioned one of these earlier in the last section. I spoke about third income streams and I said after hours air conditioning. Well, indeed, after hours air conditioning is an extra payment by the tenant. If they use the air conditioning after 5 p.m. at night, then it's a cost to the property, particularly if it's a large property, and that should be a tenant recovery. So that will be a third income stream, and that's a good thing. So there's other things to recover from the tenants, and you should make sure that they're all occurring accordingly based on consumption, e.g. electricity, gas, and maintenance. So maybe you can find some other recoverable items in the property subject to the tenant, the occupancy, and the landlord. If you can, that's good. Whatever you locate and find as regards a further recoverable outgoing, track it, charge it, monitor it, and put it in the rent statement. So there you go. I've covered the income categories. You can add to this, or certainly based on your location and by your property type, there's other things you can add to this. But that gives you a good summation of how I would look at income relative to commercial, retail or industrial property today. I check everything. You need to as well. Keep yourself out of trouble. So let's go back to the main topic. There's lots of other things here and other videos. I'll cover them for you. And every day I usually send out a video of one type or another covering important issues in sales, leasing or property management. As I said to you before, you can go to our website and subscribe to our newsletter, commercial-realestate-training.com. And if you haven't been there before, this is what the website looks like. And there are lots and lots of articles there on all sorts of things. For example, prospecting letters this morning. I also did an article on lead generation and how to learn from lost listings. The articles are many and varied, many different things there for you to look at. Several hundred articles over time. And for example, productive closing strategies for better commercial listings today. So there you go, that's there for you, and that is at the website commercialrealestatetraining.com. So this closes on the property management issue I discussed today, and that is income. And we'll go into these other items in further videos. It's good to have you here with us today. You can subscribe at our YouTube channel and get plenty of tips, tools and ideas to help you with your marketplace today. This is John Highman from Commercial Real Estate Online. Thanks for listening, and we'll catch you next time.